Well, I think this is one of the fascinating development over the past few years. So this is a concept that we call corporate Darwinism. So one of the things that you can think about is that the tech stocks can be thought of as biological organisms going through a Darwinian process of evolution by natural selection of their return on equity. In other words, they've sort of changed their DNA to be as less labor intensive and capital intensive as possible, and have sort of structural higher margins and profits. Now the question is, what's the P multiple of a dinosaur versus a P multiple of a Homo sapiens, for example?
Well, we know that.
I think this is where valuation.
What is the answer to that question? I'm
so that's the thing is we're it's sort of making history in a way of corporates landscape and corporates DNA in a way, because they have close to $1 trillion market cap. And Apple have the same size. They have almost a monopolistic situation, and they are essentially redefining and reinventing the whole concept of retail sales. So I think this is where valuation can not always capture what's called the S-curve.
Yeah, this 100 years ago with the oil companies, though. You know, these were the huge growth potential coming as we moved from horse and cart to the oil industry, the big players of this world. They were showing the dynamic growth as well. Isn't there a model there somewhere in history we can look at what the difference between a Homo sapiens and a dinosaur?
Well, I mean, you do see this across industries. And my point is that today, these sort of tech stocks or tech companies in the US don't rely as much on labor and don't create as much wage inflation as before. This is, you know, a lot of debate around the Phillips curve and how it no longer works. But I think this is also where.
Are you sure? I'm Amazon upping their workers' salaries to $15 an hour minimum.
Correct. But if you look at compared to the big stocks that we had 50 years ago in terms of the amount of labor they used to employ, these companies can be thought of as labor energy efficient, and therefore.
Which is why profit margins are so wide in the US. Correct.
And I think there's an interesting framework, which is the DuPont decomposition of return on equity, where you say ROE can be profit margin times asset turnover times leverage. And I think this is the very important point here, is that there are labor and capital intensity has completely collapsed.
For these super companies out there, and these are those companies, and most of them tend to be these tech companies that we talk about, because they're, as you say, they've become the most efficient at using that model.
Hang on a second, I've just realised he's got solutions as well. Did you work out what the difference between, have you got an answer for us in terms of how we should value them? You've posed a brilliant question in a way I've never heard it posed before, but you've got the solution, it says here.
Yes, I think the point is that P multiple don't always reflect the S-curve when growth is not linear, and I think this is the ultimate element and the challenge for investors as well.
So can we buy these stocks?
Yes, but it's almost more of a question of option pricing than it is about simply doing a linear calculation of earnings. But I think this is where you could do a 2-3 stage DCF, for example, and try to look at how the market share and the size of the market could be in the future. But I think the point is valuation do matter, but we need to also take into account the weakness of the traditional valuations as well.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.